Welcome back. Just over 100 points down now on the index. So some bit of losses extending as we are moving forward on this weekly expiry session. At the lowest point of the day now is where the Nifty is. Amisha Vora of PL Capital is now joining in to discuss more on the markets. Amisha, good morning. Thank you for joining in. And since we are on the subject of markets, I'll start with the capital market names, right? They've run up, well, almost 40-50% in the last 1 month or so, be it the likes of CDSL or BSE, or some of the other names as well, like MCX. Have they run up too much too soon, even if the market is on the mend? And if you look at the mutual fund inflows as well and so on, do these capital market names justify the valuations that they are trading at currently?
Their long-term potential is too huge, and each of them has their own, particular moat, a very competitive presence. So they are a definite part of long-term portfolio. But if you ask me in short to medium term, I do agree that there could be a possibility of a small correction, whether time or price, but yes, it has run up a bit more.
Amisha, how would you assess the market setup right now? From the April lows, we've had a fantastic run up. I think the mid-small cap index is up close to about 20%. So valuations have gotten that much more expensive. But on the flip side, we've got this RBI boost. And plus, Q4 earnings were not as bad as what was feared or compared to the prior quarters. So keeping all that in mind, how do you expect the markets to perform?
Look, market and the way we bounced back also factoring in a very low oil price. That is the underlying also one of the factors whereby our inflation, of course, along with that food. So CPI and total inflation was very, very comfortable, in turn allowing RBI to take a huge step forward in injecting liquidity as also reducing rate. If the oil, the moment which it shows, that moment continues as stronger, it has moved up almost, I guess, 10-12% in just about a week's time. And also the happening of a deal between, say, US and China might also trigger a little strengthening of dollar, not impossible. These two factors were underlying both the stoppage of liquidity outflow by FIs as well as aggressive stance by RBI. I think that there can be a bit of disturbance as both these are behaving differently, at least in the short term, say next a quarter or so. While my long-term view continues to be that markets will be in the phase of higher top, higher bottom, but this could be a time of a little correction because a good monsoon, a low interest rate, a good liquidity, and better earnings seems to be known, and a big positive trigger probably is missing.
As a broad consensus over the street, Amisha, has been the fact that private financials or financials in general will lead the next leg of upside for the markets. This RBI policy has already taken the Nifty Bank to record highs. A lot of these large private names have stepped up, be it HDFC Bank, be it Kotak Bank. ICICI Bank hasn't done that. So is it because of the fact that the stock has run up already a little too much? Exactly. And do you expect that eventually ICICI Bank too will join the party, or you would rather wait for a better entry point in a lot of these private financials, even though they have not done a great deal over the last 2 to 3 years?
No, I think ICICI Bank will continue to remain part of the core portfolio, both because the bank is doing better, both in terms of growth and asset quality. But beyond that, in terms of some of the subsidiaries also, the value unlocking will continue to happen, and they are also growing really well. So I think as a franchise, this will continue to remain a part of the core portfolio. But coming back to financials, with this kind of liquidity injection which has happened and the rate reduction, markets are very enthusiastic. What just bothers me is that while we will be reaping the fruit of tax reduction, which happened in budgets, liquidity injection, interest rate reduction, and maybe good monsoon, starting second half of the year, and numbers might start looking really good. Once again, the boat should not be rocked by the uncertainty which might come by way of maybe oil prices or a little bit technical fund flow mismatch because of the strengthening of the dollar. So while my long-term view continues to be very strong, both on the financials also, and within financials, apart from top private bank, I'm equally bullish, frankly, on SBI also. I think that also offers a very good opportunity, both because of their core business as also because of the subsidiary valuation and strength which it offers. I remain equally in long-term bullish on both select NBFCs and core capital market play. I think one will have to be bracing up for a slight period of confusion in next about 2 to 3 months or 4 months.
She spoke about ICICI Bank's subsidiary. It's ICICI Prudential Asset Management, which is likely to file for its IPO papers, and some estimates believe it could be valued at about $10 to $12 billion. And ICICI Bank has about a 51% holding in ICICI Prudential. So, Amisha, you like ICICI Bank, you like SBI, you like some NBFCs. Is it possible for you to tell us the stocks which make it to your core portfolio with the appropriate disclosure?
Disclosure, of course, is that we as a research house recommend our portfolio management schemes might be holding, in our own investments it might be holding. But apart from these two, I think I continue to remain bullish despite the run-up on a bigger story of select capital good companies. And I feel that despite the run-up and the fact that the stocks might consolidate for some time, the the runway for the defense or railway stock continues to be too long. It will be a decadal and 2 decadal stories which will continue to unfold in this. And there will be quarterly or yearly ups and downs in execution. But the need and the positioning of these stocks, whether it is Hindustan Aeronautics or some other select stocks, will continue to be very positive. Going down, I feel the sector to really watch for will continue to be the experience-driven or service-driven sector. We continue to be for a very long time bullish on hotels, hospitals. Hotel and hospitals continue to remain in our core portfolio. And apart from that, I think that now the broader consumer durables will also start participating in the overall growth in the economy and both markets.
You mentioned railway and defense names, Amisha. Does it still, the longer term, how long a term is long term, right? Because with the stocks having gone up 200-250% over the last couple of years, and with their growth not living up to the hype that they have had so far, but you see projects going forward in the future, doesn't it eventually boil down to how well they execute on that potential?
See, it's not a question that they don't have execution capability. It's that once you get an order, you always make a prototype which takes about a year and a half. It gets approved and then the commercial production starts. So those who understand that, they know that the visibility created by order book results into numbers at least 1.5 to 2 years down the line. And when that starts happening, the economies of scale will flow in, which means that even in stocks like BEML or say HEL, the margins trajectory will also improve. Now, let's take a case of Hindustan Aeronautics. I'm not saying that nobody knows this or this is not a discovered stock or an idea, but here the runway for growth is at least 10 years. For 10 years, there's enough and more orders and large orders which will keep coming, by which time equally more number of orders will come for overhauling and upgradation. So and there is no competition. A lot of what that we need to do has to be done through health. That's why the premium built in will continue. And every time that market feels or investors feel that this quarter or this 6 months they've not fulfilled the target and stock corrects, I would say that these are opportunities to continue to invest.
Very interesting insights, Amisha. Thank you so much for sparing time and joining us today. Railways and defense, of course, will continue to be the subject of much conversation going forward as well. Thank you so much for joining in. We'll take a short break, but as we do that, CNBC TV18 Access is a premium membership-based service available on CNBC-TV18.com. It offers members exclusive content, market intelligence, and expert thought leadership. The membership includes access to CNBC TV18's flagship events, interaction with our journalists, along with curated studio tours, e-learning sessions, and masterclasses, and curated lifestyle benefits. Designed for an immersive, enriching experience, it empowers members with premium business intelligence and unique lifestyle benefits. The power of insights, the privilege of access, exclusivity, experiences, and influence is yours to claim. You can become a member by logging on to cnbctv18.com/access/plans.